Well, hey there, everyone. Happy Wednesday, November 19th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an absolutely gorgeously clear day here in Redmond, Washington. Hope you guys are all doing well. I am actually fighting a bit of a New York cold after getting back from 5 days on the road, so bear with me, but voice is hanging in there just fine. I will strive to take it easy and heal up very, very quickly. In the meantime, shall we talk about charts? All eyes on Nvidia's earnings coming here after the bell. Nvidia for now up about 3.5–4% in the after-hour session. I had the initial announcement, now waiting for the earnings call and all the details. So we'll see through the course of the show today what sort of changes we see, and we'll check back in on Nvidia a little later when we're talking about some individual stocks. As always, we appreciate you joining us here on the show every weekday after the close. Questions are always welcome and very much appreciated. Use the comment section on our YouTube channel. If there's any questions that come in your mind as you're watching the episode, looking at the charts, let me know. We're planning an all mailbag episode on Friday, and we'd love to answer one of your questions on the air. As a reminder, the show has kind of three parts. We start with the market recap. We talk about stock and sector themes, looking at the heat map, and then we finish off looking at some charts together. Let's get to it, shall we? So, choppy session today, which kind of makes sense, right? If you look at where we were around 1:30, 2 o'clock yesterday on Tuesday, and you look at where we ended, kind of noisy, but no real directional movement from the afternoon yesterday. So we got up as high around 66.90. We got down to around 66.05. We ended the session pretty much at the midpoint, kind of half and half at 66.42. That's good enough for the S&P to be up 0.4% for the day. The Dow up slightly 0.1% higher. The Nasdaq Composite, the best performer, up 0.6%. Mid caps and small caps were kind of flat for the day as well. Choppy session all around. Mid caps slightly higher, small caps slightly lower. It kind of makes sense when you have a big announcement coming out, whether it's Fed meeting, Nvidia earnings, something where there's a lot of focus. There's often sort of a choppy kind of sideways, often a lighter volume session because everyone's kind of waiting to see what comes out. And I would say for the bulls, a lot is riding on this Nvidia earnings report because, there's been a lot of discussion about AI stocks being in a bubble. That AI trade has been unwound pretty aggressively off of all-time highs and coming down. Nvidia is one of those charts that's kind of hung in there pretty well, although a lot of semiconductors have pulled back pretty heavily off of their previous all-time highs. Nvidia has strong earnings. Maybe that reignites this optimism that it's not a bubble and that AI companies really are just able to, produce a lot of stuff and build out the infrastructure. I argue there's just so many bubble-like characteristics of that. So I will definitely be a disbeliever if there's a big bounce after Nvidia earnings. I think that probably is going to be a frothy move higher, would be my guess. I've been wrong before, though. I'll keep watching the charts and see what they tell me. For now, major indexes are telling me to be cautious. The VIX about a point lower today, right? So the VIX got up to around 25 at yesterday's close, 24 plus. Today we're down around at a 23 handle, 23.7 or so. So the VIX overall, remaining in a high volatility environment, anything above 20, and the more time it spends above 20, I think gives further fuel to this might be something more significant to the downside kind of fire. So for now, VIX remaining above that 20 level. Looking at interest rates, you can see bonds sold off a bit today. Interest rates generally moved higher, although it was a late stage sell-off in bonds that pushed yields higher. So the 10-year yield finished today around 4.13. The long bond yield around 4.75. The 5-year point just above 3.7%. Dollar slightly higher, kind of a nice uptrend move for the day, but not a huge upswing, about 0.2% higher for the UUP. Gold and silver continuing to look quite strong. Gold and silver both opened up quite strong. The GLD got up to 380 before selling off, closing around 375. But those charts still showing a constructive general pattern, I would say, from a technical perspective. Kind of mixed results for the rest of the energy space. Crude oil was generally lower today, and the USO finished down about 2.25%. Cryptocurrencies continuing to not be awesome right now. Bitcoin is currently bouncing back above 90,000 after trading down just below 89,000. We're up around 93,000 when we did the show yesterday. So we're continuing to see more deterioration there. All all of the top 10 coins tracked on the stock charts platform. Excuse me, in the red. The problem I have with the chart of Bitcoin, I think we talked about it on the show yesterday, and I actually just recorded a video for Stock Charts TV earlier today talking about some key breakdowns. And I think that breakdown in Bitcoin is a meaningful one, not just for Bitcoin, but what it tells you about risk appetite, right? The chart of Bitcoin has a big risk off move from 125,000 down to 90,000. And while we're getting a bit of an upward chop here, as we're recording the show just after the U.S. equity market close, the chart is looking weak. And we've broken down through Fibonacci support. We've broken down through moving average support. There's not a lot on the chart for support down to like the March and April lows, which are a lot lower than 90,600 or so. So we'll keep an eye on the chart of Bitcoin. Personally, I've been unwinding positions in Bitcoin ETFs for the most part, completely sold those off by now. I do still own some Bitcoin and Ethereum, and a little GBTC still on the portfolio. All right, looking at sector breadth, pretty much split here, although generally a little more negative than positive. Technology managing to go higher. Optimism going into Nvidia's earnings report after the close. Certainly, again, if you're on the bull side, you really need Nvidia to have of an upside surprise here, because that could exude confidence in other AI-related names, many of which have been struggling here recently. The bears would say, a brief bounce by an Nvidia and then resumption of the downtrend would pretty much be the nail in the coffin. Like if that's happening, I don't know what would save this market from going down a lot further. We're sort of all looking there. The big unknown would be all the macro data we haven't had, right? Usually by now, after last month, we've had jobs data, we've had inflation data, we've had unemployment data, we've had all sorts of things to get a read on the economy and changing economic conditions, potential impact of tariffs. We've had none of that. And so the rollout of that data, now that the government shutdown is behind us, we're still sort of getting things restarted. Still don't have a lot of economic data to work with, but that's a big unknown because now we've had a gap in data. And once that data resumes, I think one of the big risks right here would be some negative implications from updated economic data, right? It comes out, the economy's slowing down aggressively, or it comes down that, inflation is accelerating, right? Something that would imply things are a lot less optimistic than many have been arguing in the absence of data to refute that. So I think that's a risk here. Obviously, there's an upside benefit potentially if the economic data comes out pretty positive, right? And the markets could certainly go higher. For now, technology going into Nvidia's post-close earnings up 0.7%. That's your top performing sector. Financials and industrials both up about 1/3%. Materials about the same. Consumer discretionary was flat. Everything else was in the red today. Energy, which has been one of the better performing sectors, excuse me, down 1.3% today. Utilities, REITs, consumer staples, all down just under 1% to the downside. Those defensive sectors like consumer staples and real estate have been outperforming pretty well here recently. So the fact that they're underperforming the S&P today is certainly an encouraging sign, and a brief pause on that rotation from growth to value, from offense to defense that we've been covering here on the show. Looking at the breadth data, not a great breadth day. The top one is the most important one in our book, the New York Composite Index. The NYSE is a pretty broad universe of stocks, big stocks, small stocks, growth stocks, value stocks, kind of everything in one big universe. And as you can see, decliners far outpacing advancers. 61% of the NYSE listings were down compared to 37% up. On the S&P 500, a little bit better, but actually it's almost identical. 61% down, 39% up. Little better on mid caps, which are kind of a coin flip. But generally, these are not great breadth numbers today. So technology doing a little bit better. Financials, industrials, materials slightly higher, but most things down today. All right, looking at the Magnificent Seven and Friends, again, a little bit of optimism here going into NVIDIA's earnings. You can see Broadcom up 4.1%, Alphabet up 3%, NVIDIA 2.9% going into the close. Again, the aftermarket, when I was checking, it was up about 4%. We're up about 4.4% in the after hours to 195, which would take us right there. We'll check a little bit later once we get to the chart of NVIDIA and talk about some specific excuse me, price levels. On the downside, Netflix continuing to underwhelm, down 3.6% today. Microsoft continuing to move lower after arguably the most classic double top pattern I've seen in a long time, down another 1.33%. Meta also, arguably the worst chart of all of these, down another 1.25%. So some of these leading names obviously have already broken down. The question is Nvidia's positive earnings, if that's what we're going to get today, is that enough to save this AI trade? Count me skeptical, but hey, we'll see. We'll see what happens. All right, we're going to get to the heat map here now. As a reminder, if this these charts and this discussion of the market conditions here on Wednesday, November 19th, bring any questions up in your mind, please take a moment if you could on our YouTube channel, drop a comment with the question that you have. I have had some questions about a live Q&A. Probably not going to do one until after the Thanksgiving holiday, but we will get one on the calendar and we'll let you know. Most likely early December. That would be my guess. But I'll get one on the calendar and send it out to all of you. Love the vibe of a live Q&A for sure, and we'll get another one of those on the books. All right, looking at the heat map here again, breadth was weaker today, and we can see that there's a lot of things kind of flat to down today. But the real story today, at least, would be the things that are not down: Nvidia, Broadcom, Oracle, LRCX. There's a lot of semiconductors, Applied Materials, KLAC, all having decent up days. AMD, sort of a downside outlier. Micron moving lower today. So it wasn't all semiconductors, but it was enough of them, certainly. The SMH, pulling off of those previous highs. And again, we'll see what happens after Nvidia's earnings today. Nice upside swing after some a painful week of a bit of a pullback there. In the communication services sector, Alphabet stands out to me as an outlier to the upside. If you take Alphabet out of the sector and just look at the rest, not a good day, right? For Meta, for Netflix, which are the second and third largest names. Then media names like Disney, Comcast were down. Old school telecoms like AT&T, Verizon are down. T-Mobile, mobile phones down. So it was not a great day on the communication side, to be honest with you. What else stands out? I mean, financials were one of the top three performers today, and just kind of some nice, decent up days here. And charts like JP Morgan, like Bank of America, all made new all-time highs earlier in November. All of those stocks that I just mentioned have pulled back from those recent all-time highs. And I think the real question on the chart is whether on a chart like Goldman Sachs, are we pounding out a higher low? And if so, this is still a really good chart. We're below the 21-day EMA. We're below the 50-day moving average. So it's not the best chart I'm going to show you today, but it's not horrible. And so I think the challenge for Goldman Sachs and others like it is, can we make a higher low, resume this uptrend? Back here about a week and a half, 2 weeks ago, early November, we had this hammer candle here. Let me switch to a candle chart. Might be a little easier to actually see the candle. There we go. So here we have this hammer candle. This is as we tested the 50-day moving average. Had kind of a sideways pattern. Then we traded below the 50-day, but closed back above it. That's in the good short-term bounce indication. This looks like a really bad candle pattern. I don't think this is one that comes to mind, because you have a lower open below the first day's close. That might have a name, but it's just not a common pattern that I'm familiar with. It's not like a bearish engulfing pattern, one of those that that we see quite often, but certainly showed a change from accumulation to distribution one day to the next. Now we've undercut the 50-day moving average, but for now we're holding that swing low. So seems to me that low, right? That day seems to be the anchor, and holding above that, I would say pretty key. And if we start to break below that, certainly if we break below 740, which would take us below the October low, this chart doesn't look very constructive anymore because we're not making higher lows. But for now, we're seeing some accumulation on that previous swing. The momentum is still okay. So I would say a lot of these financial charts still look pretty good. The ones that have been strong, pulling back off of their previous all-time highs, but still okay. And that would be when I think about what would tell you that this market is getting worse, right? Because I think up until now, we've been kind of split. I know plenty of smart strategists that I follow are super bullish and have been talking about how things are going to be fine. I've definitely generally been on the other side of that coin respectfully, and have just been talking about things that cause me a bit of concern. And that's fine. I'm happy with a healthy disagreement, something to debate with my peers. But now that things have rolled over in the last week, the question is, at what point, if we do continue, at what point if you've been fighting it, if you're still bullish, at what point do you decide you're not bullish anymore, right? What would you need to see to sort of take on the full offensive trade? And I think for me, things that would change if you're not convinced yet, breakdowns in the Magnificent Seven, right? What we've seen with like Microsoft and Meta would just have to continue, right? Because that's the previous leadership starting to struggle. But what's happened is you've had other sectors like financials and industrials that has still looked quite good, right? GE Aerospace is not far from all-time highs. Caterpillar made a new all-time high at the end of October. Goldman Sachs made a new all-time high, last week. So all of these stocks have been in primary uptrends, but they all pulled back this week. And I think if they start to break support, if those types of names start to break support, then what's left, right? Like what are the names that you kind of hang your hat on and say things aren't that bad anymore? So for me, I think the proof is going to be in the price. And I think if we see deterioration in some of those non-Mag 7 but still strong charts, could be certainly a problem. Final comments, I would just say within healthcare, a lot of names struggling here a bit. Some of the big names that have been strong, like Eli Lilly, continuing to push new all-time highs. Eli Lilly plowed through $1,000 a share like it wasn't even there. So I'm recognizing the strength there. But other areas of the market, we're seeing some pullbacks here. Charts like BSX had really been sideways for a while, but starting to make a pattern of higher highs and higher lows today, giving a lot of that back. So watch for some short-term vulnerability in healthcare. And then certainly in energy, right? A lot of energy stocks have been looking more and more encouraging, and they've broken above resistance. Some of these have appeared on my new 3-month highs list as I'm scanning for ideas, but a lot of those pulling back here certainly today. All right, we're going to get to a lot more charts here in a moment. I do want to give a moment to my friends at Seeking Alpha. Thank them for being great partners of Market Misbehavior. Seeking Alpha has their Black Friday sale lighting up right about now. Alpha Picks is one of the products that I've looked at as I've evaluated Seeking Alpha, as I've talked to some of the experts there, guys like Steve Kress, who run the quantitative team, who I interviewed for my podcast. I love their quantitative model. It reminds me very much of quant models I would have used at a large financial institution when I used to work for one, and with others that I've been familiar with. It's called an alpha model, where you're looking for ways to outperform the benchmark by looking at individual stocks that show the characteristics of winning stocks in previous market cycles. Their quant model is used as part of their Alpha Picks platform. This is a product where they actually hand select only like 1 or 2 a month. They hand select, call it an Alpha Pick, and they dive deeper into that particular model. So it sort of combines the strength of a good quant model with the ability to dive deeper into the fundamentals and the technicals and look for strength around the board. If you sign up for Alpha Picks today, you can get 20% off, which is a pretty awesome sale going into the Black Friday holiday. You can learn more information at marketmisbehavior.com/Alpha Picks, or just scan the QR code you see next to my face here on the screen. Again, thanks to the friends at Seeking Alpha for being great partners of the channel. If you use the link, it gets you a little better deal than if you go right to the website, and it helps me make Market Misbehavior awesome. So I'd appreciate you checking them out. All right, shall we finish off looking at some charts here? The S&P 500, as we've covered, has broken below our trend channel that we've been talking about here for quite some time. So the last week, certainly vulnerable with a break below the 21-day EMA, a follow-through break below the 50-day moving average. Today, sort of a bullish inside day. That's not true because it was a higher high. Sort of just a weird kind of choppy sideways day, right? If you look, the open and the close are pretty much in the same range as yesterday's open and close. We did close slightly above the open and slightly above yesterday's close. That's not bad, but no real signs of accumulation yet. I think the S&P back above the 50-day moving average would at least give me something to be a little more optimistic about. For now, though, I am watching very closely 65.50, because if that would break, I think that's a potential issue for sure. I thought I added on some Fibonacci retracements, but I don't see them, so I'm going to do them here. All right, we add Fibonacci retracements like this. Perfect time to have a discussion. How do you select what levels to use? I always tell people, pick the levels that seem important. There's a very objective nature to some technical analysis. There's a subjective nature to other things. I think the reason why you select certain Fibonacci levels, or certain levels to set up what I call a Fibonacci framework, I think that is a little more subjective. And I always tell people, use the meaningful extremes, right? The prices that stick out, that you think that is a meaningful turn. The April low, obviously an important anchor and this all of the stuff that's happened after that starts from that point, April 7th, the low. From there, we've done Fibonacci retracements a couple times when it's felt like it's been a meaningful high, but I think for now, certainly looks that high from the last week in October seems to be a pretty meaningful one. We've spent the last 3 weeks pulling back off of that extreme, just above 6,900. So if we take the April low and the October high, 38.2% of the way down will be right around the 200-day moving average. It's currently around 6150. So 6130 to 6160, that looks like a reasonable downside objective. And I'd probably build it out a little more and say like 6130 to 6200, which would be these swing lows from July. That's kind of a reasonable downside target, I would say. If we break 6550, that would be the next reasonable downside objective, I would argue, based on the framework, based on the trend, based on moving average and Fibonacci support, all kind of coalescing around that level. We break 6550, I'll put a shaded area down there because that would be, for me, a reasonable downside expectation. RSI pulling up a bit above the 40 level. That's good because yesterday we dipped below 40 for the first time since April. So let's see if that 40 level is able to hold. That'd be a good thing. All right, continuing on. From the daily chart of the S&P, just a quick check on breadth. The breadth rolling over a bit today, as we covered earlier in the market recap. We're down to around 36% of S&P 500 names remaining above their 50-day moving average. We are still safely above 50% above their 200-day. This is already in a bearish territory and has already, I think, sent the message that's most important, which is the fact that all the new highs since the end of June have been marked by less companies being above their 50-day moving average. The long-term breadth, though, has remained okay. But if this would push below 50%, I would think that would be yet another negative sign for this market. And if it can hold 50%, that would be really encouraging. The VIX did come down slightly today. We're still well above 20. For now, this is looking very much like the pullback we had in October. So basically, October, we got down around 65.50 before resuming the uptrend. The VIX went above 20, spent about a week and a half above there before finally coming back down. And the move back below the VIX of 20 with an upsurge in prices really sort of gave the all clear for further improvement. So at this point, I think watching for a VIX breaking below 20 would be an important way of sort of an all clear sign. If the S&P is going to find support right around the October lows, VIX pushing back below 20 would be a nice bullish argument, bit of a recovery. Did have a question because I alluded, I think on Tuesday, I think yesterday, I talked about comparing 2025 to 2018. And I know that's not a perfect analog. An analog is basically where you look at a previous period in time and then you compare what's happening now and you look at how the charts line up. This is a technique that is used often. You'll find it on social media a bunch. I often have huge problems with this particular approach because a statistician, if you explained what you were doing, here's one other year, here's one other observation, and I'm looking at the current observation and assuming that what happened 7 years ago, the same thing is going to happen now, you would get laughed out of the room because from a statistical perspective, that's not a really valid argument, right? There's no statistical reason why those two charts should be so similar. So I don't think of them as a rule. I don't think of them as this is what's going to happen because it happened before. And I think a lot of people get to that conclusion way too quickly. For me, it gives you a sort of, it gives you a potential path to think about. It allows you to have an informed discussion about what's different now or what would tell me that 2025 is going to look like 2018. I'm not going to assume it's going to happen. I use this as the starting point to a really good discussion. I don't think of this as the conclusion. I hope that makes sense because I think a lot of times what I see on social media, it's like, well, this is what happened in 2018. So this is obviously going to happen now. And I don't think that's intellectually honest in terms of the benefits of comparing periods. Here's what happened in 2018. What's different now? Like what would happen? Like what would that look like? If we would have a similar drop, what would that mean? Having that kind of discussion to just think about potential paths and probabilities and how defensive or how offensive you would want to get in your portfolio, I have no problem with that. I think that's actually a great way of using charts as a learning opportunity, right? And thinking about what's happened previously. So the reason why I sort of alluded to that is because 2018, I mean, there have been very few years where the fourth quarter has been very weak, right? The fourth quarter, Q4, particularly coming out of a major low in September, October, November, and December are usually the strongest time of the year, or certainly one of the stronger times of the year. And part of that, I would say, is because we've often had a major low in September and October. And so that big sell-off, the puking out from the summer down into a fall low, means you're set up for a great recovery in Q4. The problem I have in 2025 is we never had that meaningful drawdown into a September, October low. We've had these brief little pullbacks, but we haven't had a big sell-off into a major low. So I don't think we can reasonably expect a normal fourth quarter, because we didn't have a normal third quarter, right? We didn't have that normal sell-off, which we often get. So 2018 is one of those years where you actually had a down quarter in Q4. So the highs of the year were in September. We ended up selling off into a major low right around Christmas. And I got to tell you, I've been doing this for 26 years now. This is one of the few times where I've seen a significant major low in December. That's just not usually kind of see it back here. So 2018, which is what we're looking at here, very unusual, but you also had a sell-off in Q1, right? So you had a major low in February, a major low in April, a low in May, all testing the 200-day before you ended up making new highs in September. So here is the current year kind of set up the same way. So this is 2025. It's not the same, right? The Q1 low for 2018. It was a very choppy period. For about 6 months, we sort of remained within the range that we saw in January and February. Here we had a much more significant acceleration in March and April, going into an April low, but Q1 was weaker than average, basically. We also did not have a major low in September and October. Kind of had the same thing here. Early October actually looking quite strong. By November, we had already rolled over, and I think that's what we haven't seen yet. We just haven't seen that significant drawdown. But I'm wondering if we we go into a weaker November and December, which again is not what often happens, but it has happened before. And I think the reason why 2018 could be helpful is because I remember in 2018, right? Yeah, that big sell-off. And then right here, the talk about that was it. The bottom is in. Everyone should be buying this dip. There were a lot of calls for that, right? There are plenty of people bearish at this time, to be clear. But I heard a lot of people being super bulled up because, all right, that's it. We hit the 200-day. We just buy the 200-day. We did that a couple times earlier this year. This is awesome. But it didn't hold, right? And then I think the real telling part, the real tell here that told you that Q4 was going to be a disaster were these secondary attempts to get back above that swing high that never came, right? So after that initial sell-off, we then had the lower high and we never got above it, right? So we never had enough accumulation to make a new swing high. We just kept stalling out at those previous highs. So excuse me, by the time we finally sold off in December, we'd already had lots of signs of weaker accumulation, weaker momentum. The RSI never got above 60. So I think these secondary highs, like if you weren't, bearish by then, it's like, look out, because we're not getting any sort of accumulation. We're not seeing enough positive momentum. We're not seeing the things we would need to see to be optimistic going into the end of the year. And if all you're saying, and the only reason why you're bullish is because of the seasonality, I've learned to avoid that as a sole reason to be bullish, right? Seasonality tells you the tendencies. Look at other years where we've had similar patterns. 2018 was an ugly one. So that's what I meant by that analog. I hope by comparing those charts, kind of talking through what happened in 2018, that helps you understand that a little bit better. If you have questions, use the comment section. I'm all for it. Here's the chart of Bitcoin. I saw my friend Katie Stockton on CNBC, excuse me, earlier today talking about Bitcoin and its value as a gauge of sentiment. My last episode of the Market Misbehavior podcast, I sat down with Andrew Thrasher. And if you haven't learned that, Andrew's awesome. He is genuinely a very, very nice human being, but also is a knowledgeable strategist, 2-time Dow Award winner. And that's the CMT Association every year highlights a new contribution to the field of technical analysis called the Charles H. Dow Award. Andrew is one of the few people to have won it more than once. And he did some really good research on volatility, really good research on what he called the 5% canary. But we also talked about Bitcoin and cryptocurrencies. So check out that interview on the Market Misbehavior podcast. That's on my YouTube channel. But I think the chart of Bitcoin is pretty bearish. And the reason why it's bearish, I think, starts back here, where we failed to hold the 200-day, where we failed to hold previous support, which now becomes resistance. And so I think that counter trend rally that failed was pretty much it. Now we failed to hold the 61.8% level. So I think I think Bitcoin back above 93,000 is a lot less bad. But as long as we continue here, downside objective for me, sort of in the 75 to 80,000 range. I think we get down to these February, March, April lows, because other than that, we're out of Fibonacci levels. We're out of levels of potential support based on the uptrend that we've seen. And when there's no more support left, I think there's a big vacuum to go lower. We are oversold here for the first time since February. So a counter trend bounce, I think, could make sense. But again, anything below 93,000, I think, is a pretty negative chart, and I'm waiting before I would add to any sort of Bitcoin position at this particular point. All right, that brings us to Nvidia. I just have a couple more charts to share with you. It looks like we're steadily climbing in the after hours, about 10 points higher here as we digest Nvidia's earnings. We'll see what happens tomorrow, but for now, Nvidia's around 197, which means on the daily chart, that means it's currently back above the 50-day, back above the 21-day EMA, right around here. So the skeptic in me wonders if we gap higher and have a right shoulder, and this is like a head and shoulders pattern, that's a little too aggressive about predicting what's going to happen. We'll see what happens, right? And if there's a meaningful rally, and if this is just yet another test of the 50-day moving average, and this is a sign of accumulation, that's going to help the S&P and the Nasdaq go higher, because other technology names are going to be fueled by some optimism on Nvidia's earnings. And I would say for now, I mean, this hasn't been a horrible chart. It's been a good chart. It's not been a great chart anymore because we're not making new highs, but it's not a bad chart, right? It's sort of okay. And we're still at the 50-day. For me, 164, 165, that's the September low. That's the first Fibonacci support. For me, that's like the line in the sand. If we get below that, I'm out. Out of the way. I don't own Nvidia directly, but I own plenty of ETFs, I'm sure, that own Nvidia indirectly. So for me, that's how I would approach this. It's a good chart as long as it remains above that 38.2% level. 165, pretty good ways down. Assuming a bounce higher tomorrow on earnings, that could be a good thing for stocks. I think what would be one of the most disastrous outcomes if Nvidia did have a really good earnings report, which all signs point to it is, if you get a gap higher on Nvidia tomorrow, but then we sell off through the course of the day, that would be the ugliest outcome. And if you're bullish, I would encourage you to not be as bullish if you see that, because if we have a gap and then there are signs that people are selling that gap higher, that is people thrilled to cash out after Nvidia's beat. They're still super nervous and they think this is all bubbly. And as a result, they're just trying to get out of the way and take some profits when they can. So watch that if we do get a gap higher tomorrow. I think what happens during the day tomorrow for Nvidia could be pretty crucial. Costco, sorry for the Freudian slip there. Costco broke down yesterday, continued lower today. It ended up actually trading higher and higher. It almost looks, honestly, I'd probably call this a hammer candle at this point. I'll switch to a candle chart. You can see what I mean. A hammer candle is where you have a downtrend. You have an open, a much lower trade, but by the close, we're back up toward the highs of the day. Think of this as hammering out a bottom. So the next 1 to 3 bars more likely higher than lower. If you look at what's happened in the last 6 weeks, we've had a bunch of counter trend rallies up to a declining 50-day moving average. So for me, until we get a break above the 50-day, count me super skeptical about the ability of this of the stock to rebound in a more meaningful way. But I'm looking to the left and I'm noting that we have a hammer candle right at those previous lows. That actually implies a good short-term bounce. So as a swing trade, taking that sort of bet, I think makes a ton of sense from a technical perspective. We'll see if it's able to hold it. Final chart of the day here, and then we'll call it a day. Pharmaceuticals, right? And this is one of the great benefits of technical analysis. This is one of the great benefits of having a regular process for scanning for ideas. This is what I try and reinforce with my Market Misbehavior Premium members. Have a consistent process, a daily process, a weekly process, a monthly process. That's how you get out of trouble. That's how you improve your market awareness, what we call our situational awareness. I often scan for things making new 3-month highs. And what that does is it allows me to recognize ETFs like the XPH, that's the S&P Spider Pharmaceuticals ETF, making a new 52-week high again today. This is a chart making higher highs and higher lows. The moving averages are in the proper order. If you're nervous about other charts, I'm a lot less nervous about charts like this that are in confirmed uptrend phases. They're not hidden. They're not forbidden, right? They are things you can find. You just have to have a good process of trying to find them. I hope watching Chart This with Dave Keller every trading day is part of that process for you. helping you make sense of things. And I can't thank you enough for watching the show and supporting Market Misbehavior and my work. Have a great evening. Remember, it's always a good time to own good charts. Take care, folks.